Blockchain Show is a podcast that demystifies cryptocurrencies and distributed ledger technology.
All right, Micah Fraim, welcome to the podcast. How are you?
Good, man. Thanks for having me.
Yeah, so taxes, not always the most sexy topic.
Probably the least sexy topic.
Yeah, why don't we begin with maybe a little bit of your background and how you got not only into taxes, but the crypto specific area of taxes, if you don't mind.
Yeah, so I've been a CPA in practice on my own for about 10 years now. And the biggest portion of our clients will either be online businesses or really growth-centric businesses, people who have dynamic and rapidly changing situations. So we've been doing that for a long time. And then around 2017, I bought my first bit of crypto like everyone else did. Very, very quick. This was during the ICO craze. So very quickly, the $3,000 or whatever I threw in went down to $1,000, kind of forgot about it. And then in 2020, the market started turning around and I checked and that crypto had doubled or tripled in value, even though it was a very small amount. And around that time, there's a node project that popped up that a client told me about. And it was the first time I understood the real use case for a crypto project. It was the first time that I understood why that project specifically had utility versus just blockchain or a fork of some other token. Before that, it had been really nebulous to me. I never understood why, like, cool, blockchain's great, but why is this project valuable? So anyway, that's just how, as I got more involved in that project, that was sort of like the first real entry to crypto for me. So I started digging in and investing in other projects and very, very quickly realized there's no one out there, or there's very, very few people out there who understand the tax side of it, because I was trying to figure that out, not only for myself, but also since we do have so many clients that are online businesses or are a little more tech savvy to begin with, more and more of them were investing as well. So kind of just happened from my own mix of our online clients needing to be able to service them, but also just my own sort of crypto curiosity. As I kept digging and digging into crypto itself, I realized there was just nothing on the tax side. So this is what we do most of the time now. That's our main focus, is crypto taxation. But it's funny because it happened almost by accident from my crypto hobby.
I always like to hear people's origins into this space. I mean, it's still relatively new, such an explosion of innovation and rapidly evolving. Some people refer to it as like the Wild West.
Yeah. Oh, it's a night. I mean, I love it because I like things that change quickly. I love things where if I'm doing the same thing every day, I get bored very, very quickly and I lose interest. So the same thing I love about crypto is that it is basically, like you said, the Wild West, is the same thing that makes it an absolute nightmare for a crypto investor, because the IRS has issued next to no guidance on the majority of crypto topics. And even the ones they have, because the market shifts so fast, the guidance they've given can still feel, if not outdated, it's not quite up to date at the very least, because these projects evolve so quickly that they issued guidance on iteration 1 of a certain protocol. Now we're on iteration like 5. And so these slight changes in the mechanics and how things function can make a big difference, not only in how the project functions, but also how it's going to be taxed. So it's really fun because it's the most other things in taxation, there's so much precedent out there. You've got 100 years of case law or something. With this, we are so on the cutting edge of this industry. Makes it a very exciting time, but also makes it really difficult to plan for, even for CPAs, let alone someone who's just getting into crypto and is trying to understand the ecosystem.
Yeah, absolutely. I watched a really kind of bizarre documentary about John McAfee. Have you seen that one by any chance?
I haven't watched. I mean, it's funny. John McAfee's from like a town 20 minutes from here. Or at least he went to Roanoke College. I'm from Roanoke, Virginia. He went to Roanoke College. He was either from from the town that's in Salem or Roanoke. I can't remember which. So I haven't seen the documentary, but he was a wild character, and his entire life reads like fiction.
Yeah. It's a good way to put it. The thing that really stuck out the most is, towards the end of his life, they made it seem like he made a lot of money in different crypto coins, and they were coming after him for not paying taxes on it. And he made the decision to no longer pay his taxes. And then it was this like elaborate escape on a yacht, and he ends up in a prison and in Spain, where he eventually dies.
He was a nut. Just in general, he was a nut. It was also when he died, he had that coin that came out, and they called it whacked or something. It's like he had a dead man switch on a token where if he didn't put in a code, that it would release this like whole thing to his mailing list with his altcoin.
Oh, wow.
I don't think it's worth. I don't even know if that coin exists anymore, because it was definitely an S coin, but.
Oh man.
Checking CoinGecko just now if it's even around. Yeah, it doesn't even list it anymore. It was called Whacked. But
yeah, that's right. They showed that tattoo on him. Well, I mean, as crazy as his story is, the reason I bring it up is a lot of people, when they do invest in different crypto coins, is they're not real. At least for me in the early days, like taxes was not even on my radar.
sure.
And then, once we start seeing properties in the metaverse emerge and buying and reselling those, and NFTs, it's like, yeah, well, it's a form of an asset. It makes sense that there would be taxes. I guess my question is, when people come to you, is it more of a preemptive thing, or is it like, hey, I've got this huge problem that I don't know how to deal with?
It's usually the latter. And that's one of the big issues we're running into right now, is that a lot of the clients who are coming to us because they had this amazing 2021, did not plan for that income at all. Now they've got a huge tax bill, but the market has gone down 70% or whatever from when they actually were realizing all those gains. So that's the thing that's really frustrating and difficult, is I think crypto, it just moves fast in general, and people can make a lot of money very quickly that they never anticipated making. So because it's such a sudden shift, it's not like someone started a business or they've been throwing money into an index fund every year, and it's this slow, steady growth, and you kind of are realizing what's happening and have time to plan. You have people who will go from $0 to $2 million because they got pretty lucky on their investing strategy in crypto. So that's the really hard part, is that people don't plan for it, and they're so excited about crypto because it's making them so much money that they just keep reinvesting in the project instead of planning and cashing out some of those profits for their tax bill. And that's the big thing that's just getting people hammered right now, is that they were either running nodes, play to earn games, they were just doing a lot of trading, whatever they were doing, they had a lot of realized income that they've got to pay tax on from last year, but it was all held in these crypto portfolios, which are now down, depending on what you were investing in, 50 to 100% of what it was worth in 2021 when you were accruing all of this tax debt. So normally, it's normally people, unfortunately, coming to us after the fact, which is hard, because once the year closes, we lose about 90% of our flexibility and ability to plan and tweak things.
You mentioned something there about play to earn rewards being taxable. That's something I didn't even really think about. How does that work? Yeah,
so there's one of two ways that it could be taxed, and it kind of goes to any sort of general activity that you're making money on. It can either be taxed as a hobby or as a business. And the IRS has like 20 something criteria that you have to look at for, maybe not 20, it's at least 10, where it's like, are you conducting this in a business-like manner? Is the motive behind this profit? What level of expertise do you need? Are you keeping good records? Stuff like that. So the example we'll give is, or we'll give two examples just for kind of a juxtaposition. Like, let's say you're a 13-year-old kid and you're playing some World of Warcraft ripoff, and you're in a dungeon and you get some really rare drop. And the kid is playing it on the weekends for a couple hours. Well, that's hobby income. That's pretty, look at his age, look at the expertise, look at how much time he's spending it. That's hobby income. But in that same game, you could have a dad who he's supporting his family because he's got a blacksmithing shop or something within the game. And he's just doing a really mundane task and just grinding out weapons 40 hours a week. And he's really analyzing the game, figuring out how to increase his profitability. Well, even though that's in a game, that is pretty reasonably business income. So there's good things and bad things about both of those. It really depends on how the big thing you run into with hobby income is that after 2018, when they did tax reform, you're no longer allowed to deduct you used to be able to deduct your hobby expenses up to the extent of income that you had. Well, they just got rid of that. So if you've got hobby income, it doesn't matter if you reinvested all of that back into the game, you still have to claim that as income. That's not a big deal if you get a couple $100 worth of income during the year. But if you're like the dad who has, you've got $100,000 of revenue and $80,000 worth of costs, not being able to deduct those costs is a big problem. So the downside to it being business income is that business income is subject to what they call self-employment tax, which are the employee and employer halves of Social Security and Medicare. So any bit of profit you have in the business, you've got to pay Social Security and Medicare unless you set it up in a corporation. So it really comes down to which one you want. One, you've got to look at what actually supports the classification. Are you running a business or are you just doing something as a hobby? But which one ends up being the most advantageous largely depends on how much reinvestment you have back into the activity. Because the more you're playing the game, the more likely you are to have to reinvest in the game, the more likely you are to be happier to have it as a business, be classified as a business, so you can deduct all of those expenses you're accruing. And then if you're making enough profit, you probably want to have it set up as an S corporation, which can have some pretty significant savings on that profit. But it's easy to get in the weeds on that if we're not too careful. So not sure how much detail you want to go into.
Man, it'd be really hard to explain, being a virtual blacksmith to like your in-laws. You know what I mean? But hey, whatever works, man.
Well,
I mean, I wish
people,
I could make.
I doubt they're doing it anymore, but there was this documentary years ago on people who had played Second Life. It was called Life 2.0. It was kind of depressing because the people who were really into it was not the most well-adjusted and balanced. Like there's some real addiction component to it. But one of the people is really interesting, where her whole thing was designing clothes or houses or things within the game to sell to other players in the game. And that was her full-time job, just grinding that stuff out 12 hours a day. So it's existed in some capacity already, just not on the blockchain, but it's definitely an odd thing to try to explain to somebody, like you're saying.
Just blockchain in general. It's even you're doing the show like 6 years, and that's still a question that I really don't enjoy answering.
It's so hard to explain. I think unless you're a tech person, which I'm not, it's really difficult to fully understand, and let alone then try to, once you wrap your head around it well enough to mostly understand it, then try to explain that to another person is, at least for me, extremely difficult.
People come to it from so many different backgrounds. It's not quite so simple as, I mean, we've talked to lawyers, healthcare people, obviously financial developers, real estate. I mean, you name it, the list is growing and growing and growing, which kind of leads me to my next question about wealth management, because as you pointed out, there's been tremendous growth. There's also been periods not so much, but from a tax perspective, how do you advise people to not only protect themselves to make sure they don't get hit with a huge tax bill, but going forward, be careful and, try to manage wealth?
In terms of minimizing the tax bill, it really depends first on the type of activity that the person's involved in, because the project that really made sense to me, that one that made everything click, was nodes. So I'm big into nodes. It's probably my favorite aspect of crypto. So node projects and mining are taxed one way. Then you're going to have it to where if you're trading NFTs, that's another way. And if you're creating NFTs and then selling them, that's another sort of, it's these different buckets of taxation as to how they're treated. And then based on which activities you're involved in and also the scope of those activities, are you making a couple $100 or are you making $1 million? That's going to largely inform if we do some kind of corporate structure, how we're expensing things, stuff like that. So that we have to sort of drill down into the buckets of what they're doing and all the particulars of their tax situation to figure out what to do. But a few things that are kind of across the board, especially now that we're in this bear market, that we advise pretty much every client on. There's a few that I think that is good for everybody to think about. One is, and this sounds astoundingly simple, but it's not, people don't do it, is that if you're having realized transactions, so not if you're hodling, and you've got your Bitcoin, it's just sitting in a cold wallet and you're leaving it alone, but if you've got realized transactions to where you're trading actively, you've got mining or node income, you've got staking income or interest rewards coming in, you need to take a percentage of that and just set it aside for taxes. Because otherwise you're going to run into the situation we talked about earlier, where what happens is the IRS not only has it taxable in whatever activity you had for the year, but they're assessing that income based on what the crypto was worth as of the date of that transaction. So let's say you've got some node income that's coming in and it's a node project that's doing really well. And so every day as you're getting your node rewards, you're getting $100, $200, whatever it is that's being deposited into your account. That is taxable based on the fair market value of the token that day as you're receiving it. Well, it could be that next year the token goes from $1 to 1 or 2 cents. So if you wait until April 15th to sell off some of your portfolio for taxes, you're not going to be able to pay it. We've got a few examples where I always change a few details on this, but we had one person come to us who had $1 million worth of realized gains from all of his crypto income. But the problem is that they were getting a lot of it from an NFT project, and they just kept reinvesting back into all of their profits that were taxable income. They just kept reinvesting into the project. Well, then not only did the market crash, but that project crashed hard to where it's worth it dropped 99% from its peak. So this person had $1 million worth of profits, generates a $400,000 to $500,000 tax bill, but now their portfolio is only worth $100,000 or $200,000. So they've got a real tax bill with no actual mechanism and no assets to pay the tax bill. But if they had, instead of reinvesting all of their profits back into that project, if they had just set aside 40 or 50% in every time they got a deposit, sell off some of the crypto and throw it into a bank account, obviously their portfolio would be down, but they're not almost going to have to declare bankruptcy because of all this income they made, but then the market crashing. So that's one of the big things, and it's super, super simple, but I think especially real crypto bros and the more of a zealot you are either for blockchain or for your particular blockchain project, the less inclined you are to cash out at all. And that's fine if you're just buying and holding. But if you have anything that triggers an actual taxable event, you've got to set that money aside for your tax bill. And sort of what dovetails into that is the other thing that we talk about is that stable coins are not fiat currency. Because a lot of times what people do if they are cashing out is they're just going to convert it to Tether or USDC or something, park it in a centralized exchange, and then earn 10% interest on it. Well, that's great, assuming the exchange doesn't go insolvent like we've seen with Celsius and Voyager, or that the token doesn't crash, which we saw with UST recently. So that's the main thing we say. That's the simplest things, but it's one of the big things we talk about is cash out as you have these realized taxable events, and make sure you're doing it in actual fiat currency. Or if you want to hold in a stable coin, understand that that's fine, but there's a lot of risk to that if anything goes wrong with the token or the place that you're holding the token.
I can understand why some people would not want to do that. You know, the whole ethos is
right
to get away from needing to use banks and all that. But I mean, you bring up a really good point. So are you saying it's like, how often should someone do that? Almost immediately after, or on like a schedule, or
whatever frequency they can remember to do it. You don't want to do it once a year or something. The idea is to try to match the amount of reserves that you have to pay your tax bill to the tax bill that's being generated. So if you're generating taxable events for 6 months, well, the value of that token is going to be changing a lot during that time. So that creates a higher probability of a mismatch in the tax bill you have and the money you have to actually pay the tax bill. So it's not like you got to do it that day necessarily, but once a week, once a month, whatever you can kind of remember to do, that's going to decrease that variance that you could run into otherwise.
Yeah, I think the volatility of just so many projects out there it's really hard to navigate. But I wanted to go back to, the NFT example. Say someone is creating NFTs and they just hold on to it. At what point does that become taxable? I mean, what if somebody does want to just keep their funds as a crypto coin and they hold on to it for maybe years, or say they want to convert it to another coin? At what point along the way is there going to be like red flags thrown up with the IRS?
Again, it depends on the activity. If you're someone who's you're a dev and you create an NFT project and you just hold on to it, well, that's not taxable until you actually have income from it. So in that case, it would probably be when you're selling it to other people. For coin trading coins, one of the most basic things, but that's still really widely misunderstood, is people will think, and this is another thing that really gets people in trouble, is people will think that it's not taxable until you convert it back to a fiat currency, until you cash out to actual US dollars or euros or wherever you live. At least for the US, coin for coin trades are taxable. That's one of the few things the IRS has issued very concrete guidance on. So if you're trading Bitcoin for ETH, for ADA, for whatever, every time that you do one of those trades, you've got a capital gain or a capital loss, which again is one of the reasons why, kind of going back to why we tell people, if you've got income, make sure you're cashing out some of that to cover the tax bill, because otherwise what happens is people just making a lot of trades, doing great, keep rolling it back into another crypto project, and they're accruing taxable income with every one of those transactions. But then when it comes time to sell, well, they were making these trades when Bitcoin was 60K and now it's below 20, and they've got this big tax bill, but they don't have the cash to actually pay it.
And I know that everyone's tax situation is different. How much they should set aside is dependent on which tax bracket they're in. Yeah. Just right off the top of my head, I was just going to say, like, just set aside 30% just in case. Would that be too high a number?
No, I mean, because unless you're just holding, and unless everything you have is long-term capital gains, where you're holding the crypto for at least a year before selling it, unless long-term capital gains are taxed at a maximum of 20%, but your ordinary income federally can go up to 37%. So short-term capital gains, mining nodes, staking rewards, most every other category of crypto income is going to be taxed as just your ordinary regular income tax rate. So it really depends on how much you're making, not only from crypto, but from other sources. But I'd say depending on most of the time we'd say 30 to 50%, depending on how much you're making, is going to be a good kind of benchmark.
Okay. Yeah. Do you ever see a time in the future where maybe this could all be handled online well, not just online, but through some sort of combination of the technology we're talking about? Because it just seems like we're going way back to like
Yeah.
old school. I know that it's going to take a while to get different systems updated, but
Yeah.
it seems like in my mind there's got to be a better way.
I think what we're going to run into is that for simpler sort of core, just trading and things you're holding on a centralized exchange and the more basic trading activity, I think the IRS is going to force crypto exchanges to act almost like brokers for traditional securities, where at the end of the year, they're going to be responsible for keeping track of all of this stuff for you. And at the end of the year, you issue you a 1099 with a summary of all your trades, the interest you earned, the staking rewards, airdrops, all of that. So I think that's going to be because the IRS is already pushing more and more regulation, not only on the crypto space in general, but also on specifically exchanges. So I think first the IRS is going to really push them, and they're already doing it a little bit, but they're going to continue to push more for the exchanges to report all of the income that you have from the exchange. I think then they're probably going to force them to do traditional brokers. If you're trading a security, they're required to keep track of your cost basis for you so that you can accurately represent how much you actually made. I think the IRS, once they really get all of the income being reported, then they'll move to try and get the brokers, these exchanges to track the cost basis as well. So I think if you're doing everything on a Coinbase, a crypto.com, something like that, and that's where all your activity is, I think eventually you're just going to be getting a 1099 that covers all of that for you. But if you're in true DeFi, I don't think it's going to happen for a long time, because that kind of goes against the whole thesis behind crypto to begin with. So I think the decentralized exchanges, you're still going to have to use Coinly or CoinTracker or one of those softwares, which will hopefully get better. But I know it's not an easy problem to fix, because these are blockchain devs who are creating these software programs, but they still feel like they're in beta testing a lot of times, especially if you get into any of the slightly more nuanced and more cutting edge things like liquidity pools, nodes, NFT trading. They're not very good at tracking. So I think for a rambling answer, centralized exchanges, I think more and more of that's going to be handled automatically. But the things that are true DeFi and things like play to earn games and mining, I think you're still going to be responsible for tracking that yourself.
Okay. Yeah. Just to bring it back to our Wild West example, it feels like, the marshals have arrived. The IRS is here. The Pinkerton agency is on the hunt,
Well, and one of the things that we have to talk to people about is they say, well, the IRS I've never reported any of this before. I didn't report that, and the IRS hasn't gotten me yet. And there's two things that we kind of tell people with that, or a couple. One is just follow the law. You don't want to be a felon and committing fraud. And the other is that the IRS, people are confusing the IRS hasn't caught me yet with the IRS cannot catch me. And given the IRS's up until now, they got that big infusion of hiring more agents, but the IRS is way underfunded and way understaffed. So they haven't had the resources to really go after people, but they're also not stupid. And during this time, they've been developing more tech to try and help them track who's using crypto and where they're using it. What the IRS is going to do is, as they get more, these tools are developed more, and as they get more concrete guidance from Congress, because the IRS will issue guidance, but they're always happier if they're just enforcing a law, because then it's not like they're the ones who are having to interpret it and defend it in court. They're enforcing what Congress told them to do. As they get more and more guidance from Congress and their tools are getting better, they're just going to go retroactive and look at all of your activity and accounts, and they're still going to be able to audit you for it. So what's going to happen to some crypto bros who think that since they were doing it all on MetaMask that the IRS can't figure it out is the IRS is going to come back and say, hey, we think you've had crypto activity for the last 6 years. We're going to need for you to account for that. And some people are just going to get absolutely hammered. And depending on how compliant they are and working with the IRS, and depending on what they were doing at the time, how much they were trying to shroud and hide that activity, could actually have criminal charges against them. I think that'll be absolutely the exception. Most people are just going to, oh, you forgot to report it, right? No problem. Here, pay a penalty. But there's going to be a handful of people where it's pretty clear that they were really actively trying to defraud the U.S. government.
Yeah, never a good idea. Not worth it. I mean, the whole nature of, going back to Bitcoin was, it's pseudo anonymous, really to build trust that it would work. And, in so doing that, if an agent really knew what they were doing, and I'm sure software will come along, you can track everything. It might not even take a warrant, but you can absolutely track it.
Yeah. What else? I mean, people will forget that blockchain is auditable by design. For that trust, all of the transactions are public on the ledger. And people, again, they'll say, well, I'm doing it all on DeFi. There's no KYC on this. It's all on this decentralized exchange. But the question we always ask is, okay, well, how did you get it to that exchange? And for the vast majority of people, you're funding it from a centralized exchange that has KYC. So all the IRS has to do is look at what you were doing on that exchange that has the KYC, and they'll see you're sending a bunch of money to these different wallets, and then they're going to investigate the activity on those wallets. They're not imbeciles, and they're going to be able to tell what's happening, that you're not just buying all this crypto and then just donating it to somebody else. They're going to realize that's yours. And again, depending on how much activity you got, that could be a lot of tax that you should have been paying that you weren't.
That's a really good point you bring up. I think that it's just one of those things you're better off, planning for it so you don't get surprised later. And
yeah, I mean, that's the whole thing that we're doing with people is, look, you've got to report the income. There's no way around it. But the timing of your transactions, how you structure things, because certain buckets of income, you'd want to be running it through an LLC or a corporation, is we talk about loss harvesting. We talk about the timing of your transactions. You're going to have to report the income, but there's a lot of things we can do to help mitigate that tax hit, either in absolute terms or at least just where you're paying a much lower tax rate than you would if you just were doing it on your own.
Well, it's fascinating. I mean, I'm sure there's just, obviously every situation is different for, different clients you have. I'd love maybe sometime if you can come back on, we could dig into some of that a little bit deeper, but
yeah, that'd be great.
I see that you've written a couple books. Was that before the focus on crypto taxes?
Yeah, it was, but it's funny. I need to update that my one pager, because we actually did last month publish another book specific to crypto taxation. It's called Decrypting Crypto Taxes, and that's on Amazon, Barnes & Noble, Apple Books, all of those. And the digital version of it is free right now. Obviously, the paperback and hardcover and Audible versions, those you have to pay for, but the digital version we've got completely free. So if anyone's wanting to dig into any specific topics, that's kind of the way we tried to structure it, is based on like FAQs and the things people would be asking us, making sure we had a chapter for each one of those.
Okay. And where can people go to get the free version? Is that
on all of those? It's just on the retailer site. So if you go to Amazon, Barnes & Noble, Apple Books, any of those, it's there for free download.
Yeah, well, that's very kind of you.
I can either make $1 per book or 25 cents per book, or give people a pretty good resource. So we just rather, there's just not many people who are doing it right now. And one of the things that we even have to talk about is that the IRS hasn't issued guidance on the vast majority of these things. So what we're doing in a lot of the chapters of the book is finding something that's analogous within traditional investing or business or some other kind of more established part of tax law. But because of the fact that there's so little concrete guidance, it is such a nightmare for people to try to navigate this. And even if they have a CPA, the CPAs, if they're not in this, if this isn't their world, they look for highest guidance and it doesn't exist, so they don't know. So it's a little bit of our attempt at a public service to give people somewhere to start, because there's just not much out there now.
So we're in this, bear market, crypto winter to a large degree still. How can people kind of use this to their advantage for the next bull run? Do you have anything on that?
Yeah, there's two main things. And one is you want to do loss harvesting. So, and crypto is like sort of right now the perfect vehicle to do that, not only because most people are holding at least some of their portfolio at a loss, but also because crypto is not subject to what they call the wash sale rules. At least right now, they're trying to close that loophole, but when it will happen is unclear. But for traditional securities, like if you've got some Amazon stock or something and you're holding it at a loss, if you sell that stock, you're not allowed to buy it back for at least 30 or 31 days. Otherwise, that loss is disallowed, because they're saying, okay, you sold the stock and bought it the next day. You didn't really sell the stock. You're not really disposing of it. You were just trading it to try to generate a tax loss. But because crypto right now is not considered a security, it's considered property, it's not subject to those wash sale rules. So you can have, the example I'll give is, let's say you bought you decided to get into crypto at the peak and you inherited some money from mom and dad, and you bought 10 Bitcoins for 60 grand a piece. Well, now they're down to, see, that's $600,000 you spent. Now that's worth $200,000 because the market has crashed so much. So that's a $400,000 unrealized loss you have if you just leave it in your portfolio. But what you can do is sell the Bitcoin, buy it right back, and you have a realized capital loss of $400,000 that you can use either to offset against gains that you have in that year, if you have any, or it just carries forward indefinitely. You can either use $3,000 of it at a time to offset against ordinary income, or when you have capital gains. So for when we do have a bull market again, that's just a really easy strategy to just have these built-in losses, so that the gains you do have are all tax-free up until that loss carry forward is exhausted. So that's, at least as long as that loophole exists, that's one of the big things we talk about. The other things that will, and again, there's other strategies that aren't really specific to the bear market. Again, corporate structure, timing of transactions. But the other thing that we'll talk about is that since this is a down year, it's counterintuitive, because most of the time you're trying to defer your income as much as possible, because then you're deferring the tax hit. You're trying to push it down the road so you don't pay the tax. But in a down year, it can sometimes make sense to accelerate that income, take the hit now, because you're already in a lower income year, and the gains that you're making are probably going to be done at a lower dollar value as well. So it depends on your investment strategy, the type of income you're having, all of those things. But depending on the particulars of your situation, it can make a lot of sense just to take the hit now, realize that taxable event, because when you sell in a year or two, there can be some pretty significant tax savings. But again, that gets a little specific to the project. There's one example I'll give, but it's like it's a 10-minute example, which we don't have time for, and it's very specific to this one type of project. But those are the two main things that we talk about in the bear market: potentially accelerating your income and taking the hit now in a lower income year, and also making sure you're tax loss harvesting and any losses you're having, making sure they're being realized.
Yeah, man, I can really see the value that you bring to people's lives. I want to just thank you for coming on and sharing your insights with us. Very, very thought-provoking. If people are just getting into crypto and they're hearing this, I'm sure they're thinking, man, I don't know anything. But encourage those listening to keep going. Maybe if you would mind leaving us with ways people can connect. I know you mentioned the book, but is there any other places they can go to learn more?
Yeah, easiest place to get in contact with us is if you go to cryptotaxcpa.com. That's our website specific for cryptocurrency investors or businesses, and it's got some free resources on there as well that should be helpful.
Awesome. Well, Micah Fraim, I really enjoyed talking with you. Thank you.
Yeah, man, this was great. I really appreciate you having me on.